Money is one of the most powerful ideas ever created by humanity. It has no physical value of its own, yet it controls empires, shapes civilizations, starts wars, and decides the fate of billions of people. Money is invisible, yet it rules the visible world. It exists only because humans believe in it, and yet that belief has been strong enough to build cities, destroy nations, and define human history. From the earliest days of human trade to today's digital transactions, money has constantly evolved. It has changed form, structure, and meaning countless times. But now, for the first time in history, experts around the world are asking a radical question. What if money as we know it is about to disappear? This is not science fiction. This is not a distant future. This transformation is happening right now. Across the globe, economists, technologists, bankers, philosophers, and policymakers are locked in an intense debate about the future of money. Some believe physical cash is nearing extinction. Others argue that digital currencies will redefine power itself. And some warn that the coming changes could reshape freedom, privacy, and control in ways humanity has never experienced before. To understand where money is going, we must first understand where it came from. Thousands of years ago, money did not exist. Early humans lived in small communities where survival depended on cooperation. Goods and services were exchanged directly through barter. A hunter traded meat for tools. A farmer exchanged grain for shelter. Value was simple, personal, and immediate. But barter had a fundamental flaw. It required what economists call a double coincidence of wants. Both parties had to want exactly what the other offered at the same time. As societies grew larger and more complex, this system began to collapse. Trade expanded beyond villages. Goods needed to be stored, transported, and valued across time and distance. Barter could no longer support growing civilizations. So humanity invented money. The earliest forms of money were physical objects with intrinsic value. Shells, stones, beads, salt, cattle, and eventually precious metals became mediums of exchange. These items were durable, rare, and widely accepted. Over time, gold and silver emerged as the dominant forms of money because they were scarce, divisible, and resistant to decay. Gold coins became the backbone of global trade. Empires rose and fell based on their access to precious metals. Wealth was tangible. Power could be weighed. But gold had limitations. It was heavy. It was dangerous to transport. And it was difficult to divide for everyday transactions. To solve this problem, paper money was introduced. At first, paper money was not money itself. It was a promise, a note that represented gold stored somewhere else. People trusted that they could exchange the paper for real value whenever they wanted. Over time, this promise changed. Governments realized they did not need to keep enough gold to back every note. Gradually, currencies moved away from the gold standard. Money became fiat, valuable not because of what it represented, but because governments declared it valuable. Trust replaced gold. This system worked until it didn't. In the 20th century, banks became the central authorities of money. They controlled lending, savings, interest rates, and economic growth. Money became increasingly abstract. Credit cards, checks, and electronic transfers replaced physical exchange. By the early 2000s, most money no longer existed as cash. It existed as digital entries in bank databases. Then came the year 2008. A global financial crisis shook the world. Banks collapsed. Entire economies fell into recession. Millions of people lost their jobs, homes, and life savings. Governments bailed out financial institutions while ordinary citizens paid the price. Trust in the traditional financial system was shattered. People began asking uncomfortable questions. Who controls money? Who benefits from the system? Why do banks get rescued while individuals suffer? Out of this chaos, a mysterious idea emerged. Bitcoin. In 2009, an unknown individual or group using the name Satoshi Nakamoto released a white paper describing a new form of money. Bitcoin was decentralized. It did not require banks. It did not rely on governments. It was powered by cryptography and a revolutionary technology called blockchain. For the first time in history, people could send money directly to each other without an intermediary. No bank approval, no government permission, no centralized authority. To some, Bitcoin represented freedom, a way to escape corrupt financial systems, a tool for financial sovereignty. To others, it was a threat, a challenge to state control, a system that could enable crime, tax evasion, and economic instability. Governments were skeptical. Banks were alarmed. Economists were divided. Was Bitcoin the future of money, or just a digital experiment? As Bitcoin gained popularity, thousands of new cryptocurrencies emerged. Ethereum introduced smart contracts, self-executing agreements without human involvement. Stablecoins promised the benefits of crypto without volatility. Decentralized finance, or DeFi, challenged traditional banking by offering loans, savings, and investments without intermediaries. At the same time, something quieter but equally powerful was happening. Cash began to disappear. In many countries, people stopped carrying physical money. Mobile payment apps replaced wallets. QR codes replaced coins. Contactless cards replaced cash registers. Online shopping normalized digital transactions. In some cities, businesses stopped accepting cash entirely. This shift raised new questions. If money is digital, who controls it? If every transaction is tracked, is privacy gone? If cash disappears, can governments control how money is spent? Experts began warning about a future where money could be programmed. Money that expires. Money that can only be spent on certain items. Money that can be frozen instantly. Then came central bank digital currencies, CBDCs. Governments around the world began developing their own digital currencies. Unlike cryptocurrencies, CBDCs are fully controlled by central banks. They are legal tender backed by the state and integrated into national financial systems. Supporters argue that CBDCs will make payments faster, reduce corruption, prevent money laundering, and include people without access to banks. Critics warn of unprecedented surveillance. A digital currency controlled by the state could monitor every transaction, could freeze accounts without warning. It could limit where, when, and how money is used. Supporters say this power could protect society. Opponents say it could destroy financial freedom. The debate intensified. Some experts believe the future of money will be hybrid. Physical cash, cryptocurrencies, and digital government money will coexist. Others predict a fully cashless world within decades. Meanwhile, artificial intelligence entered the financial system. Algorithms began managing investments. Trading bots replaced human traders. Credit decisions were automated. Smart contracts executed financial agreements without human oversight. Money was no longer just currency. It became data. This raised a deeper and more dangerous question. If money becomes entirely digital, what happens to power? Historically, whoever controlled money controlled society. Kings minted coins to assert authority. Empires dominated trade routes to gain influence. Banks financed wars and governments. Money has always been a tool of power. Now that power is shifting. Technology companies are building payment systems used by billions of people. Cryptocurrencies challenge national borders. Governments respond with regulation, surveillance, and digital control. The future of money is not just about technology. It is about trust. Trust in institutions that have failed before. Trust in algorithms we do not understand. Trust in systems we cannot see. Experts warn that inequality could grow. Those who understand digital finance may gain power and opportunity. Those without access, education, or technology could be left behind. At the same time, new possibilities emerge. Unbanked populations gain access to global finance. Entrepreneurs build decentralized systems without permission. Individuals gain control over their assets like never before. The future of money is filled with promise and danger. Will cash survive as a symbol of freedom? Will cryptocurrencies replace banks? Will governments tighten control through digital currencies? Or will an entirely new system emerge? There is no single answer. What is clear is this: money is changing faster than laws, faster than institutions, and faster than society can fully comprehend. The next decade will decide how value is stored, exchanged, and controlled. And the decisions made today will shape the economic reality of future generations. The debate continues, because the future of money is not just about finance. It is about freedom. It is about power. It is about who controls the world of tomorrow. And this time, everyone is involved.